The big question is, when I look at these returns, I still get nauseous. I don't know if I threw up, did I? Did you catch that on camera? I hope not. So I still look at those returns and can't believe what I'm seeing. So the question is, what is really going on here? And so what I'm going to do is kind of walk you through what I believe is the true origin of this crisis. First of all, financial crises really are not new. Financial globalization is a messy process. In fact, between 1945 and 1971, there were 38 full-scale financial crises. Between 1973 and 1997, there were 100 of these crises. Who knows what changed in those two periods? We came off the gold standard. So when we went to a fiat currency standard, we inherently took on a whole lot more risk and volatility on the planet. Well, the reason that you're not probably as familiar with going through financial crises is typically those are only for the emerging markets. And so they don't happen in the developed markets as much. In fact, in this study, only one occurred in the United States of America, and that happened during the S&L crisis back during 1990 and 1991. So let me introduce you to the financial crisis world. The question is, why are emerging markets so crisis prone? Well, first of all, emerging markets by nature are a little poorer than developed markets, and to fund their economic growth, they have traditionally borrowed money from the developed markets to finance their growth. Well, they have very immature financial markets, right? We actually sell bonds in dollars. That's a huge advantage for us, but if we were in Thailand and wanted to borrow money, we'd have to do it in foreign currency. So we'd borrow in dollars and then we'd buy assets in Thai baht or whatever. And that creates a big currency mismatch. Now, when foreign direct investors decide they don't want their money in Thailand anymore and start pulling it out, it makes the currency go down, which makes the value of the debts go up, the value of assets go down. So that creates a huge mismatch, a huge liability mismatch, and ultimately, and this is happening, by the way, right now in Central and Eastern Europe. Now, we have to figure out if we can contain that brush fire and how big a deal that's going to be, but this is precisely what's occurring right there. And so eventually this leads to debt and it leads to defaults. To give this a visual representation for you, here is the prelude to the Asian crisis. In 1992, Thailand borrowed in foreign currency the equivalent of about 6% of its GDP. In 1996, that was 27%. Good portion of their GDP, their liabilities in foreign currency. When their currency broke, it took them down. And this is the rest of Asia, as you can see. And the one thing about financial crises is they are extremely expensive. So I'm going to walk you through just the cost and the magnitude of what happened in that Asian financial crisis. Here is Indonesia. That cost them roughly 55% of their GDP to get out of that. Here is Thailand. Again, not a good PR move because they actually had to spend less of their GDP than Indonesia, and Indonesia was in better shape going in. Here's South Korea at 28%, Malaysia at 17%, Philippines, eventually Russia. Remember, Russia defaulted on its sovereign debt, which ricocheted over to New York City. John Meriwether, Nobel Prize winner, was running a mutual or a hedge fund, long-term capital management, that then blew up. Bernanke had a late-night intervention with some bankers, and they bailed it out. So this little crisis over here did ricochet around the planet and threaten our markets as well. So the emerging markets learned something during this period. And what they said was, this is ridiculous. We need a new strategy. Here was the new strategy. They were going to peg their currency low against their biggest trading partner, and that's us, the United States. And then they're going to invest in the export side of their economy, and that's going to be their source of economic growth. And then they're going to save more than they invest back in their economy and accumulate huge dollar reserves to act as a self-insurance policy so that if they ever went through this again, they'd have, some nuts stored away. This chart represents that strategy shift. This is the emerging markets in the oil-producing countries. This orange bar, think of that as their bank account, okay? So their bank account ran negative, which was a reason for them to be crisis-prone. And then in 1998, they said, we've had it, and they started filling up their bank account with dollars. Well, because, we're on a finite landscape here on the globe, for them to generate all of this savings in dollars, it had to come from somewhere, and it came from us, okay? So they accumulated lots of dollars that they then lent back to us that we then spent on imported goods that went right back to them. They made some profit, they saved it, they lent it right back to us. So basically it was like vendor financing, okay? And the U.S. ended up looking, in a current account deficit standpoint, we've talked about this in the past, like an emerging market, and the emerging markets looked like the mature economies. So now who's emerging? This is a pretty, this is an R-rated chart right here. This is about as nasty as it's going to get. Here is a chart of the debt level in the United States of America going back to 1920 relative to our GDP. This is the increase in debt going up to 300% right before the Great Depression. And we went through this long period of deleveraging, which is a period we're in right now. Now, having said that, it gives me some comfort to tell you that even though we were deleveraging all the way through the 40s, that was actually a year of positive investment returns. So it's not necessarily law that if we're deleveraging, the stock market has to go down. Then we climbed back up steadily, and then in 1980, when we got a new economic regime that liberalized the banking system, we started increasing our debt levels, and then we sort of reached some sort of maximum sustainable rate until Asia said, look, we got a whole bunch more cheap money for you if you want it. And we said we do. And we went up to 350% debt to GDP. Now, question is, who borrowed all this money? Was it the government? No. Contrary to popular opinion, the government's debt to GDP ratio from 74 to 2008 was relatively unchanged. Was it corporations? No. If you look at non-financial businesses, they stayed about the same. So they were pretty prudently managed through that entire time period. Households? Yeah. We'll take some of that debt. So we went from about 40% to about 100%. But the most egregious offenders, the financial services industry, which went from 20% all the way up to about 120%. And so it was the households and the financial services business that consumed a lot of this capital that was available. And where do these two businesses meet? In your living room. And so here's a history of housing prices going all the way back to 1890. Robert Shiller put this chart together. It was in the New York Times. It was very talked about. But obviously, between 2000 and 2006, which is when we peaked, housing prices basically doubled, which was completely unprecedented. The only time we saw a spike that big was when the boys came home from World War II, and obviously they were prudent. Obviously, having learned lessons from the Depression.